Okay, guys, I hope you people are doing well. So, welcome to the next session of this financial management. Today, what I'm going to do is that I'm going to do some of the questions which we have not covered up till now. I mean, like in our previous session, we did questions on investment appraisal. We did some questions on the business finance. So, we are now going to move forward and we're going to take things through. So, next is basically question number 213, which is La Forge Company. I'm going to go about with this question number 213, La Forge Company. Okay, so this is the question, the name of which is La Forge Company. It says La Forge Company is a listed company which designs and manufactures air conditioning units, which are then sold through third-party retailers and distributors. Economic growth in a number of Asian countries has increased the demand for its products, and La Forge Company wishes to target these markets in order to generate sales and profit growth. Now, what exactly are the questions requirement? It says for the right issue, calculate the following: the theoretical X right price and the value of right per existing share. That's number one. Number two, assuming the investment goes ahead, calculate La Forge forecast earning per share for the coming year and the resulting share price. If it finances the investment using each of these alternatives, the right issue and the loan notes. Then it says discuss the ways in which a company can issue the new equity shares. Then lastly, it says at a recent board meeting to discuss so and so, so and so. Now, first of all, what we are going to do is that we're going to talk about this first one, which is for the right issue, calculate the following theoretical ex-right price and value of rights per existing share. So can you people just go about this and can we just start discussing this? Okay. Now see, let's just try to do the question. It says to target these market, LaForge needs new machinery, which will require investment of $25.48 million. The two options for raising the finance are being considered: a right issue at a discount of 30% on the current market price of 2.6 per share, an issue of 6% loan notes redeemable at a price of this. LaForce P ratio is 11 times, and this is expected to remain unchanged, whichever financing option is chosen. So your irrespective of the financing option, your P ratio would remain the same. Now extracts from the financial statements are as follows: profit from operation, and then there is this share capital, and so and so, so and so, so and so. Now what next is there? It says without the new investment, the forecast profit from operations for coming year is expected to be the same as the previous years. If investment undertaken, the forecast profit from operation from coming year is expected to increase by 4.5 million. LaForge company pays tax at 20%. LaForge company pays tax at 20%. So now let's try to discuss this. So if we try to attempt one of the parts of the question, which is that we have to calculate the theoretical X right price, and then we have to calculate the value of right per existing share. So let's try to do how we are going to do it. This is so there's this LaForge company, number one, which is theoretical X right price. Theoretical X right price. How are we gonna do it? We're gonna say $25.48 million is what they have to raise. $25.48 million is what they have to raise. So right issue price is gonna be what? Is gonna be 2.6 multiplied by 1 minus 0.3. Number of right shares to be obtained. Number of right shares to be obtained is gonna be 25.48 divided by 1.82. 14 million right shares is to be obtained. 14 million right shares to be obtained. Now, if 14 million right shares is to be issued, so now what do? We say for the theoretical X right price calculation, 14 million shares at 1.82. And the existing number of shares are what? 35 divided by 0.5 million shares at 2.6. Hence, this is going to be the theoretical X right price is going to be this divided by this. So if the question's requirement is to calculate the theoretical X right price, this is how we're going to calculate. We're going to say 2.47 is the theoretical X right price. Is that okay? Now, So that was one of the requirement of the question where we had to calculate the theoretical ex right price. And the second thing is that it says the value of right per existing share. So value of right per existing share. How are we going to calculate that? Let's try to see. The value of right is going to be like this. The value of right is going to be theoretical ex right price minus the right issue price 0.65. Value of right per existing share is going to be like this 0.65 multipliable multiply 14, because what we are doing is that we are doing against the 14 million shares, we are getting this right. Out of the existing how many shares? 70 million shares. So you'll get 1.03 per existing share. So the question's requirement was this, that the value of right per existing share is what you had to calculate, and we have now been able to do it. Value of right per existing shares. Right? So this is what we have been able to calculate. Now let's move a bit forward and let's discuss further. The next requirement of the question is that assuming the investment goes ahead, calculate LaForge's forecast earning per share for coming year and the resulting share price if it finances using each of the right issue and the loan notes. So now what you need to do now is that you need to do the calculation in this manner, that how this investment is going to be calculated. So now, can you just give it a try? Can you calculate the forecast earnings per share if the investment under the right issue or the loan notes? Ah, see, okay. Okay, so now what actually happens is that we have to calculate that how exactly are we gonna. Okay, so what we have to do is that we have to actually do the calculations that what is going to be the impact on the profit of forecast earning per share. So let's say number one, with respect to the right issue. With respect to the right issue. Existing profit after tax. Existing profit after tax is 16.56 million. Additional profit is 4.5 million. Tax on additional profit. Tax on additional profit is this. Hence, the revised PAT is going to be this. The revised PAT is going to be this. The revised number of shares is going to be 84 million. The revised number of shares is going to be 84 million. Forecast EPS is going to be this divided by this 0.24. So forecast EPS is going to be 0.24. Forecast EPS is going to be 0.24. Forecast share price is going to be P ratio multiplied by EPS. So it's actually going to be, because the P ratio is expected to remain the same 11 times. 11 multiplied by this. So 2.64 is going to be the forecast share price in case of right issue. Let's just talk about the second situation, which is in case of loan notes. The additional profit is this. Interest on loan. How much interest do we have to pay? Are we being given the 6% loan notes? 6% loan notes. 25.48 multiplied by 6%. Right? Okay. Additional profit before tax. Additional profit before tax. The tax on additional profit is going to be net additional profit after tax is gonna be this plus this is gonna be this plus this. Hence, the revised PAT is gonna be like this. The revised PAT is gonna be like this. So 18.94 is what it is. 18.94 is what it is. Right? Okay. Now, if I talk about revised number of shares, the number of shares won't change. So hence, resultingly, EPS is gonna be this. The share price is gonna be this. Is that okay to all? Is everyone okay till now? Yeah, is that okay to all of you? Okay. Let's move a bit forward and let's discuss further. The next aspects of the question is this. Discuss the way in which an entity can issue new equity shares. So you have to discuss the ways in which entity can issue new equity shares. Let's try to discuss that what they are. Now see, so when we talk about the ways of issuing the new equity shares, so the different ways of issuing equity shares are as under. Right issue, private placement, initial public offering, which is the IPO, plus the public offer. Now, what is generally happening in the right issue, which is issue of shares to the existing shareholders, selling of shares through intermediaries, listing of a company on a stock exchange. Offering to the public at large, suited for already listed company. Suited for unlisted companies. So these are the different ways of issuing the shares. Now let's just move on to the last requirement of the question where it says at a recent board meeting. At a recent board meeting, to discuss the financing options, one of the directors suggested reducing the forthcoming dividend. In the past few years, LaForge has consistently paid an annual dividend of 0.08 per share. Its shareholders include both financial institutions and individuals. Discuss and recommend whether LaForge should raise the finance it requires by reducing the annual dividend. The amount of finance required is 25.48 million, right? 25.48 million. Amount of finance raised through reducing dividend. That is actually gonna be, you have 70 million shares in issue, right? 5.6 million. Additional amount to be raised is this minus this. Now let's try to understand this. The question is that the examiner says that in case if we reduce the dividend, so what we could do is that, see, what you would do is that you would say that by reducing the dividend, the total amount required for the expansion would still not be raised. The total amount required for expansion would still not be raised. would still not be raised. The impact of reducing slash not paying the dividend will be multiple. Signaling effect, clientele effect, liquidity preference. It would give a signal to the market that not all is well and may lead to investors disposing of the shares and hence impacting the share price adversely. The clientele effect is going to be the clientele effect is that the shareholders include a mixed category of the investors, and this would mean that they will have mixed reaction. An entity may lose the dividend hungry shareholders. Some prefer to stay liquid if they do not get the desired return. The category of such shareholders may this category of shareholders, such shareholders may move away from this investment. So the question's requirement was he asking us for some suggestion? Recommendation. The recommendation is to go for the alternative sources of finance and do not reduce the dividend payment as it will have adverse impact on the shareholders' confidence. Right? So that's how it should be. It would have an adverse impact on the shareholders' confidence, right? So this is what they should do. They should not skip the dividend, because the dividends are something that's going to actually help them. Now let's move a bit forward. We have got this question, Tanza company. Okay. Can you just look at this question for 5 minutes and see if you can do this? Tanza company. Yeah, take 5 minutes. Try to do this question, Tanza company. Okay, let's just see. It says Tanza Company currently has the following sources of finance at 31st December 6. The capital structure and its nominal values have not changed for many years. So ordinary shares $50 million, 6% convertible loan notes, 4% bank loan. The requirement of the question is calculate the after-tax weighted average cost of capital for Tanza Company. Critically discuss with reference to relevant theory the view of directors A and director B. Discuss two factors for Tanza Company to consider in making the decision to raise debt finance or equity finance. So that's what you have to actually do. Now let's just try to see things. So basically, now next situation is that it says the ordinary shares are currently trading at 5.55 per share and have a nominal value of 0.5 per share. An ordinary dividend of 0.85 has recently been paid. Directors indicated a dividend of 0.90 will be paid on 31st December 7. Tanza Company's dividend and share price have grown steadily at 6% per year for several years and are expected to continue to do so. So what happens is that we have to calculate the weighted average cost of capital, right? Tanza Company is what it is. Tanza Company is what it is. So for the cost of equity, use of KE is equivalent to D naught 1 plus G divided by P naught plus G. So KE is equivalent to 0.9 divided by 5.55 plus 0.06. Hence, 22.16% is the cost of equity. 22.16% is the cost of equity. (22.22%) is the cost of equity. What is it? It's a cost of equity. Now, what next is there? Next situation is that it says each loan note has a nominal value of $100 and is currently trading at this. On 31st December 19, the investors holding convertible loan notes may convert into 20 ordinary shares. If they choose not to do so, the loan notes will be redeemed at nominal value and so on, so on. So what happens is that the share price has grown steadily, right? For the convertible loan notes, What is the conversion value going to be? The conversion is after 3 years, right? On 31st December X9. So what is it actually gonna be? 31st December X9 is when the conversion is going to be, right? 31st December X9. So if the conversion is gonna be at 31st December X9, how would you do it? Let's try to see. Today we are at 31st December 6, so 31st December 7, 31st December 8, and 31st December 9. These are the 3 years. 3 years, right? So hence it is actually gonna be 20 multiplied by 5.55 multiplied by 1.06 power 3. So conversion value is gonna be like this. Redemption value is 108.5. Redemption value is 100. Investor will opt for conversion. Hence, what's gonna happen is that you would say cost of convertible loan notes is gonna be time period 0, 0, 1, 2, 3. So it is like 108.51. Then what else is there? 108.51. Then what else is there? Every year there is a 6%. There is a interest, right? How much is that? That is actually gonna be 6% convertible bond. The tax rate is 15%. 6% into 100 into 0.85 plus. So hence resultingly, the cost is gonna be 11% is the cost approximately. 11% is the cost approximately. 11.22%. So we've been able to get two costs. Now we need to move a bit forward. Now we need to move a bit forward. And you need to now understand the third one, which is Denza needs to further 200 million long-term finance. Have been discussing whether this should be done using equity or so and so on. So now 4% bank loan. So for the bank loan, it's gonna be 4% multiplied by 1 minus 1 minus T, which is 0.15. Bank loan is gonna be 3.4%, right? Bank loan is gonna be 3.4%. Now, if we have to calculate the weighted average cost of capital, how would we do that? So for the weighted average cost of capital, you would say instrument value, cost in terms of percentage, cost in terms of dollar. 50 million divided by 0.5 because it's actually 0.5. Right? So this is what it is going to be. This is what it is going to be. So your weighted average cost of capital is going to be, your WACC is going to be this divided by this. 17.385 is the WACC going to be. The WACC is going to be 17.385. So is that okay? So we have actually been able to do this specific question also, which was about the discussion. This was about the computation of the weighted average cost of capital also. So basically, through this specific question, we have now been able to do how the weighted average cost of capital would be calculated. So today, what we have been able to do is that we've been able to do two questions. One of them was about the right issue and the theoretical extra right price and things like that. And the other one of them was basically the Tanza company, which was about the computation of weighted average cost of capital. So in case if any one of you has got anything to ask, you're most welcome to ask, or else I'm going to end the session now and we're going to move on and we're going to discuss maybe tomorrow or day after further. If there are any question, please ask. Okay. So thanks a lot, all of you. Thank you for your time. Thanks for attending the session. We will actually be discussing further, inshallah, in our next class.